Okay, and we're now looking at auditing, Chapter 10, continuing with Chapter 10. We're on page 512 or so, looking at responding to the identified risks of material misstatement. So when we have found material misstatements in our or risks of material misstatements, I should say, not actual misstatements, but risk of material misstatements, we need to determine the appropriate audit procedures to perform. Audit procedures should be proportional to the assessed risk. Areas of higher risk receiving more audit attention and effort. So not just this goes for material misstatement risk as well as inherent risk, but the higher the risk, the more we need to do. The only way we can confirm that something is correct, or at least materially correct, is if we do the proper procedures to make sure that that's true. And the higher the risk, the more procedures we need to do. Responding to those identified risks typically involves developing an audit approach that contains substantive procedures and tests of controls both. Okay, not just one or the other. It's almost never just one or the other. Okay, so example, this is exhibit 10.5 on page 513. So panel A, a sufficiency of evidence and existence and completeness of cache. So client A, if they're low risk, then I do less test of details and higher test of controls. Why? Because if they're low risk, then as long as I can confirm that their control risk is also equally low, I don't have to do as many tests. But when I have a high risk client, I'm not as worried about controls because effectively I don't think the controls are working anyways, or at least not working well. So I'm more likely to test more details. Generally speaking, if I'm looking at these two charts, client B is going to be one that takes more time. The less I can rely upon controls and the higher the risk of material misstatement, the more time and effort I'm going to have to spend as an auditor on audit procedures. The test of details come out to be quite a bit more, and usually it makes for a more expensive audit too, so companies usually don't prefer that. Let's skip through the questions. Okay. Now I'm on page 514. Obtaining evidence about internal control operating effectiveness for cache. For integrated audits, the auditor will test operating effectiveness of important controls throughout the year with heightened focus on controls at the client's year end. So remember, an integrated audit is one where I'm kind of auditing at least somewhat throughout the entire year, either by spot checking, but going in regularly, auditing, or doing some audit procedures quarterly, or even having an integrated software system where I can just check, I can actually get into their system and check things out. If the auditor wants to rely on controls for a financial statement audit, the auditor will test the operating effectiveness of those controls throughout the year. Okay. Selecting control tests and performing tests of controls. The auditor selects controls that are important to the auditor's conclusion about whether the organization's control adequately addresses the assessed risk of material misstatements in the cache account. The auditor will select both entity-wide and transaction controls for testing. Typical tests of transaction controls include inquiry of personnel, performing the control, observation of the control being performed, inspection of documentation, confirming that control test has been performed, and reperformance of the control by the individual test of control. So by testing the control. So effectively, this is kind of like not only like walkthroughs and reperformance, but also inspecting documents. If there's sign-offs, whatever the type of control is, not only making sure that that's being done, but even observing it being done, showing the documentation that it's being done, and even just confirming reperformance. Sometimes just confirming that the people who are doing it actually know what the control is and what it is they're doing. Okay, examples of tests and controls. I'm not going to go through all these, but cache receipts are appropriately recorded. I'll go through number 2. There's a segregation of duties between those handling the cache and those recording cache transactions. And how we can test this is performing a walkthrough of the processing of cache collections, review documentation providing evidence of duties. If internal control is not working, then there's inadequate segregation of duties between cache received and cache deposited. Employees can steal cache, covering it up with a lapping scheme. The auditor will expand confirmations with customers and select a sample of daily deposits and trace accounts receivable credits for payments. So remember that segregation of duties is one of the most basic internal controls, and especially with cash, that's the case. So we want to make sure that if we find something, or if we find that controls are not doing what they're supposed to be doing or intend to be doing, that we expand our testing. So we'll talk a little more about confirmations later in this chapter about exactly how those work. But that's a good example of exactly what we do if we find a lack of internal controls on cash receipts. All right, I'm on the bottom of 515. I'll go over to 516 as well. Considering the results of our test of controls. So when we actually perform the test, we need to determine, like we kind of just did in the last exhibit we just looked at, were the controls good, were they working, were they not working, that kind of thing. And once I make that decision, that's when I can decide whether or not I need to have any additional procedures or change what I'm doing. So a controlled deficiency, if we identify a controlled deficiency, that means that we need to assess those deficiencies and determine their severity. Is it a significant deficiency or a material weakness? Is the kind of the two options that we can have. And we need to possibly modify our preliminary control risk assessment if we find this. It depends if we already had thought it was going to be weak in the first place. We modify it if we find a deficiency and we did not think the controls were going to be weak. Obviously not the case if we already thought the controls were going to be weak. And documenting the implications of these control deficiencies. If no deficiencies are identified, we need to look at the preliminary assessment of control risk as low as appropriate, determine the extent that controls can provide evidence on the correctness of our account balances, and determine our plan's substantive audit procedures. Remember, we have more substantive procedures if we have less internal control rather than more. Okay, 516, obtaining substantive evidence about cash accounts, disclosures, and assertions. In performing substantive procedures, the auditor wants, 1, reasonable assurance that the client's cash transactions are in accordance with GAAP, and 2, that substantive procedures perform for all relevant assertions related to significant cash accounts, disclosures, and assertions. So we want to make sure that we're testing everything that we need to test, and we want to make sure that the transactions are being recorded in compliance with GAAP, which is the entire purpose of the financial statement audit in the first place. So the auditor needs to make sure that they consider what procedures they need to do for the cash accounts and what needs to be performed, and make sure those are performed. Whatever we're determined needs to be done needs to actually be done and documented. And we're going to talk about, again, documentation here in just a little bit. We can also do substantive analytical procedures. With cash accounts, though, this isn't really very effective. The main reason is that the amounts coming in and out of a cash account, well, for one thing, there are some accounts that rarely have increases and decreases. For example, expenses pretty much always just increase unless we got a problem of some kind. But cash, because things are going in and out of it all the time on a regular basis, there's usually a high volume of transactions. There's a high variance in how much each transaction is for. Data analytics just really doesn't show as much as it can with a lot of other accounts that the company has that we can use data analytics on. It's not real effective on this. Instead, we usually focus on substantive tests of details themselves, everything from bank reconciliations to actually tracing down checks and invoices and that kind of thing. Minimal substantive analytics that an auditor might perform includes identifying significant differences between the budget at the beginning of the year and what was actually recorded at the end of the year. So budget variance analysis. All right, I'm on page 518. Cash accounts, performing substantive tests of details, things that we do. Inspecting or reperforming bank reconciliations. Always, every audit I've ever gone on, we've always reperformed bank reconciliation for year end at a minimum. And honestly, too, if you ever go out on an audit, that's usually the newest person's on the job. They're the ones responsible for the bank rec. So that'll be your day one audit, the first audit you ever do. You'll probably be responsible for the bank reconciliation. Obtaining bank confirmations, and we'll talk about those in a little bit. Obtaining bank cutoff statements and preparing interbank transfer schedules. So what do these do? Okay, assertion, existence, and occurrence of bank confirmations. And we have an actual example of that here in a second, but remember, bank confirmation is something the auditor sends directly to the bank so they can confirm that the balance actually exists, that it's there. Why? Because an external party we can trust more because they have no bias in the scenario as compared to an internal party who could be biased in some way to make sure their cash accounts look better. Inspect and reform bank rec, we'll look at one of those in a minute. Completeness, obtaining bank cutoff statement, making sure that everything is complete, not only complete, but also put into the right time frame. Rights, again, that's the bank statements that look at bank balances are actually owned by the client. Valuation allocation, obtain bank cutoff to ensure the client has not held open cash receipts. Book to record the next period's sales and current period's revenues and cash, basically shifting revenues or expenses. Presentation, determine any restrictions to cash and appropriately disclose. So, for example, if there's collateral or if there's some sort of restricted cash, that happens in not-for-profits a lot because you can restrict cash based on donation requirements. Okay, so this is an example of, this is 10.8 on page 520. This is a bank reconciliation. A couple things I want you to notice about this. I'm not going to go through this in detail, but I actually highly recommend that you do. Because what we haven't got to do in this class, and I don't know whether we're going to get to because of the fact that we're at home rather than in the classroom at this point, is create a good work paper. Okay, so this is what we would call a work paper within a document. Now, within an audit. Now, this is a bank reconciliation. So some important points about this. It should look similar to what you've seen from bank recs in class. Notice that we have our adjusted balance here that matches with our adjusted balance here, and we start with the balance per bank statement, and then we have balance per book, so we have our additions, subtractions. But what's almost more important, because hopefully a bank reconciliation is familiar enough to you at this point that you understand that part. But what I want you to notice more than that is things like the fact that it's marked by who it's prepared by. Once it's reviewed by usually either the manager or the audit partner, they'll sign off and they'll date it. Notice that it's important to date what the bank reconciliation is for. Things like listing out outstanding checks, also really common. But perhaps the most important thing that I want you to see is notice how almost every number on here is marked in some way. Okay, I've told you in class before about tick marks. That's what these are. And you probably have this in one place throughout the audit, but you can also just label every single work paper if you want to. And down here you see every single one and what every single one means. So F almost always means footed, which is true. TB is almost always trial balance, which means this matches up with the trial balance. This cross here means it's traced, okay, to the deposit slip, like these two were, and so on and so forth. But I would really highly recommend looking through this, because this is what a work paper, when you go out on an audit, this is what you're going to see. You're going to see last year, if it's an audit you've done in the past, or the company's done in the past, you're going to see this from the prior year, and you're going to make sure you know how to read it and know how to utilize it. So like I said, I recommend looking through that some more. But that's what a bank reconciliation looks like. This is what a confirmation looks like, and this is exactly what they look like. I mean, we sent these out, you know, by the hundreds at the audit firms, and this is exactly what they do. So we send this directly to the bank. Something else we actually always do is we don't actually put an amount on there. We let the bank fill that in and have them sign it. That way there's no bias from them to just say yes or just sign it. They actually have to look up and see what the balance is at a given time frame so that we can confirm that. So we'll put the account name and account number, but we will generally not put the balance in there. We leave that up to the bank to do. And we do have to have the customer sign this so that we have the authorization to see this. So that is something that we need to do, you know, ahead of time. But after we get that signature, they won't see that, and it goes directly to the bank and directly back to us for, like I said, a third-party external confirmation of the bank balance for the existence assurance, amongst others. This is a loan guarantee confirmation. This is on page 523. So we're getting close on time. So this is the last thing I'll talk about. So I'm trying to keep these under 15 minutes. So this is just checking with about a loan, or if there's any guarantors on a loan. And it's just basically gathering information if there's any contingent liabilities and just what liabilities there are, what the interest rates are, all these types of things. If they're collateralized, these are all important things because we need to disclose them. We also need to make sure that their liabilities are stated correctly on their financial statements. And I'll stop there for this video.